Anyway, thanks, Steve, and let's hear what David has to say. David, welcome back to F.A.C.E. I'm going to not tell the same old joke about promotions. And I'm going to unmute you. Okay. So welcome back, David.
Good morning.
How are you?
I'm well, thank you.
Good. So good time to be talking to you as we things continue to unfold. You know, I think you tweeted or someone tweeted that piece that what happened and what continues to happen in the Fed funds market, repo market, that those pressures are going to be magnified in December. I forgot the reasons why, but I'm really interested. You've sent me a few tweets and what's been unfolding since the last time we talked. So if you just select which, you click the share button there to share your screen. See the green box?
Well, I don't. 1 second.
There's a pop-up menu
with
several options. One of them is share.
Share.
There we go. Did it work? Oh, no.
You need to
start. There you go.
There you go.
There you go. So we're looking at your Twitter right now.
Very good.
Twitter messages.
Good morning, gentlemen.
Good morning. How are you, David?
I'm well, thank you.
Okay, so
I'd like to just can I just go through a few slides here? You know, what you mentioned there about the repo problem is going to get better, and I think you're referring to
worse. In December.
In December. I think you're referring to the interview with Zoltan Pozsar. Is that the one?
I'm not sure. It was the Bloomberg article.
That was Bloomberg, and he's from Credit Suisse, and he's very, very good at understanding the plumbing of the repo market. I'd like to make it. He's saying that due to window dressing issues at the end of the year and
I see.
Other matters, as with last year, that there's going to be a sudden liquidity demand, and he's saying of the order of $600 billion is what he thinks that the market is short. Now I'm paraphrasing a little bit, but in round numbers, that's his number. Now, I'd like just to go through some slides here and show why I think we could need a little bit more than $600 billion to...
What's $600 billion among friends, right?
Yeah, exactly. $600,000 million.
And David, I don't know what the screen looks like for our viewers, but it shows all the slides you want to show. There you go. Okay, it was blocking the bottom.
Yeah.
Now it's back up. Okay.
Yeah.
All right, so Fred. What's Fred Flintstone saying here?
Well, this is your Fed funds rate running back to the early 1970s or 1970s. So you can see the peak there at 19%. And then
I remember it.
The cause of our malaise is this.
That was Volcker. That was intentional.
Yes, it was, because the problem...
That wasn't a liquidity crisis. They called him the liquidator.
Yeah, and he liquidated a lot of people. The problem they had there is from 1970 to 1980, the price of gold went from 35 to 850 an ounce, and they had to run rates to 19%, so roughly 9-10% above the rate of inflation, to get people out of gold and back into bonds again.
Okay.
Now, they solved that problem with gold in 1987, right about, you can see my pipper there, but right about there.
Yeah.
And that's when Alan Greenspan became Fed chairman, and also the Bank of England created the LBMA, which is the world's foremost gold trading platform. And they substituted the trading of gold from using actual bullion to using promissory notes. Yeah. So they have promissory notes to deliver metal in the spot market, and you know they peaked at over 250 million ounces a day recently in trading. But what that did was it allowed the continual decline down to zero. That gold should have gone bananas as we're getting down here, because In reality, we're probably running about a negative 5% real rate. When you look at what inflation really is, it's 5 to 8%, something like that. We're using the old 1980 BLS model of the CPI. So we've run to very, very negative rates in reality. I know your real rates that you're seeing from the Fed are quite a bit more than that. They're saying inflation's in the 2.5% range. But anyway, so that's that slide of the continual decline. And as the interest rates declined, it led to a rapid increase in the amount of outstanding credit. And we can see here, this is all sectors in the United States economy. And you can see how it absolutely ramped here, and up here we're at about $73 trillion. So that's 340% of GDP. The historic norm in 1970 and prior was about 150% of GDP. So in round numbers, we've got about $40 trillion of excess debt with respect to comparison to the historic norm.
Can I ask you something, David, in this whole debt picture? A lot of people believe that ground zero, of course, in 2008 were all the derivatives off housing, and people think this time it's going to be in the corporate debt market, that even though things are okay, a lot of the corporate debt is being downgraded, and a lot of that debt was used for financial engineering and stock buybacks, etc. Do you think that could be the fuse that lights a debt crisis in the corporate debt market?
Yeah, I mean, 2008, the fuse, and this is directly from one of Ben Bernanke's speeches, the fuse was actually the high yield debt market. That went off before that, and I'll show you a graph of that just in 1 second.
Okay.
But it's like what's happening now in the repo market mirrors what happened in 2008 in Q1. So I'll get to that in 2 seconds.
Sure.
But with the run up in the debt there to 73 trillion today, this is the structure of our markets out there. So we have we've got the repo market, and this is the value of these markets. So the repo market worth about 5 trillion, and about 4 trillion of that rolls every night. And you can see why that has everybody's attention, because if you seize up that market, you'll have a discontinuity in the financial system and a very, very quick decay. The 14 trillion is the amount of liquid money in the system. It's both physical currency, it's deposits with no holds. And the total of that is 14 trillion. It's the Austrian measure, the TMS measure. Now, some people use MZM or M1 or M2, and to varying extents, each of those undercounts or overcounts various components. I think the TMS measure, which is all the money in the system, is the best measure. And here is the Z. This is 73 trillion. It's gone up a trillion since I printed it a couple of weeks ago. But this gives you a sense here of that's the amount of liquid money in the system that's available. And there's your total amount of debt. So you've got 5 times the debt in the system. And then finally, these are interest rate sensitive derivatives in the system that are held by banks, and held by banks only. This number is tripled if you look at the other derivatives out there. But I'm looking at the stability of the banking system. Now, these rate sensitive derivatives, they're sensitive not just to interest rates themselves, but they're also sensitive to interest rate volatility. To what extent, it's not exactly clear. But
what are they trying to hedge with these instruments? Everything?
Yeah, I think ultimately what these did was they pinned rates. I think they used derivatives to pin rates because it creates tremendously powerful levers to the movement of rates. But and there's certainly a goodly amount of speculation going on in there as well.
Okay.
Now, this goes back to the TMS, to the true money supply measure, and that is the blue curve here that you can see. So this is an annual rate of change. So you can see here, we looked at this one last time, but sub 5%, you're constricting the money supply. That's the annual rate of change of the outstanding money. So it's the outstanding rate of change of this $14 trillion that's in the system. And what you can see here is that constriction of the money supply for a couple of years blew up the dot-com market, and it blew up the high yield market and the housing market, and then everything else for the GFC. And then now here we are again since basically Q1 2017, they constricted it down into this danger zone. And the reason that it doesn't have to go negative, it used to have to go negative in the 70s and 80s to cause a monetary event, let's call it that. But the reason that it's just sub 5% right now is because of that tremendous leverage. You've got a 5-to-1 leverage of currency or cash, liquid cash in the system versus the debt market structure. So 5-to-1 leverage, that debt has to be supported and it has to be increased to continue the Fed's Ponzi bubble or speculative bubble that they've got going. Now, what happened here in 2008 with that constriction of the money supply? Now, this is out of a BIS report, but this is the leveraged loan market, and this gets back to your very good point there, Dale. And we're seeing here in Q1 2008, so this is just a quarter of the market, but we can see this is double B rated and single B rated, but this is your leveraged loan issuance in the US. And you can see here that, Bear blew up at the end of March. So this was pre-Bear, and it was pre-Lehman Brothers. Lehman, I think, blew up in August of 2008.
Okay. And
So
these were big downgrades.
Yeah, so you can see here, that's Europe, and here is the US. So you can see, you're up here at over $400 billion in issuance, and that constricted down to less than half of that. That market essentially was done in the first quarter. And that was, you would expect this to happen just from a logical standpoint. If you think about when you constrict money in a speculative bubble, the first to fail are the most leveraged, the most, those that are the least creditworthy. As you constrict the money supply, they're dependent on the continual issuance of additional debt to roll the existing debt, continue the speculative bubble. So
I know I had my own speculative bubble.
Yeah.
And, in '08, and I was playing the credit game.
Yeah.
And then I remember once a housing crisis started, say I'd have like a $40,000, $50,000 Amex credit limit that was cut to whatever my outstanding balance is. So, credit crisis, one thing, David, they say, it also affects people that are credit worthy. They can't get credit either.
Ultimately, yeah.
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 I lived it.
They get hit last.
Yeah.
But the first to go are those that are teetering on insolvency. And you can see here that this market is ultimately what I believe is showing up in the repo market is the problem in terms of the least creditworthy. And we'll see it here on this slide. This is the Goldman Sachs slide. And what this slide shows here is the percentage of the leveraged loan market that has its ratings of B- and below. So you can see the explosion here in the great financial crisis.
And all these years, it never got back to the '08 levels.
Never got back.
That's what's really interesting to me because, I'm a technician. I go, wow, that, this implies new highs to me if I just looked at a chart like this.
Yeah. Dale, this is ZIRP here. And ZIRP never solved the problems because it never took out the malstructuring of the economy. It just levered up the economy.
Wow.
And so
it's a continuation.
Yeah.
The big wave is coming.
It's coming. And you're seeing this, here's the decay, this accelerating decay. And now this market is around $1 trillion market. So it's not the world's biggest market, but everything has its tripwire. And I think what we're seeing here is this accelerated decay here has shown up in the repo market. and is reflected in the unwillingness of cash holders to lend adequately to meet the accelerating demands of the least creditworthy as the money supply was taken away. Now, just a quick note here is that the drop down to this 3% level, which we are currently at here, in terms of the increase in the money supply, taking away or declining it from a rough run rate of, let's say, 8% down to 3% since Q1 2017, has taken away roughly $1.5 trillion plus dollars out of the U.S. economy that would have been fed into it if they had continued with that loose money policy that they did there during the Obama administration. And there's an additional impact here of slowly increasing rates. When you've got $72 trillion of total debt out there, each $1 trillion of increase in interest rates creates an additional cash demand just to service the debt of about $720 billion a year. So you've got that combined impact there, is that we've had roughly $2 trillion pulled out of the economy since this tight money policy of the Fed was accelerated. So feeding from the repo market and the interventions that we're seeing there on a daily basis, what is the net impact? And this is from Northman, Sven Hendrick's work. The top one is the 10-year 3-month inversion of the yield curve. Mm-hmm. And the bottom one is the SPX, the S&P 500. And you can see here, it's not the inversion that kills you, but it's when you become uninverted again. And the
like what's happening now in the last month or so.
Exactly. And so this really feeds into the conversation you were having before I came on, is that we're now in the zone where you're having this inversion unwinding, and you're back into the area here where we should see very, very shortly the consequences of the removal of credit from the system.
Can you explain to people who believe that since the Fed got religion after December and reversed course, and now they're all the money that's being pumped in that they don't want to call QE at all.
Yeah.
Why it hasn't fixed things? Is it because of a lag in monetary policy? For people who think the Fed has corrected itself in time, what do you say?
The interventions in the repo market feed the financial market. What happens in each of these cases here, where you have a prolonged secular tightening of the money supply and removal of availability of money, is that in essence you're drying out the economy. Monetary policy takes years to impact the economy, and so what we have is a creation of credit dependency here with really, really long-term loose money policy. Runs right back to 2008. You get the horns there, and it never really got below 8% that whole time in terms of the year-over-year increase. And that creates this credit dependency and malstructuring of the economy. And so when you lower the money supply, which is the year-over-year change of the money stock, when you lower that down to this level, if you want to use the vernacular, it really is drying out the economy and drying out the availability of capital to sustain the economy. So what the Fed has done with the repo market is that they are addressing a problem in the broad economy, in the decline of creditworthiness in the entire economy, and they're addressing it by meeting liquidity requirements of the financial markets. And those are two very different things. The financial markets are very tightly focused, and it takes time for any kind of monetary intervention, which running about $3 trillion now in terms of the reversal of the Fed.
So for the real economy,
300 billion, pardon me.
For the real economy, there's a much longer lag time.
Sure.
But in financial assets, it's more reflexive to what it does.
Yeah.
Is that what you're saying?
It addresses credit shortage in the financial markets and to some extent in the broader economy, but it takes years for it to reach there. And I misspoke. I just said 3 trillion. It's about $300 billion of interventions now that the Fed have applied into the repo market. So you've got two problems here. You've got Zoltan Pozsar points out that there's roughly a $600 billion shortage to meet the liquidity requirements here of the year end of the financial industry. But what they've done ultimately by the Fed has done by tightening monetary policies, they've destabilized a portion of this $72 trillion debt bubble. And they've also destabilized the portion of this $200 trillion derivatives bubble, which is rate volatility sensitive. And so, all of these are dependent upon the creditworthiness of the players in them. And so this repo market here is really a portion. It's about a $5 trillion portion of the credit market, which rolls every night, but it's really signaling that there's a problem. The shortage here undermined the effective support of the existing debt that's in the market there, and it can knock on into this other $200 trillion portion. So I'm arguing that, as we saw in 2008, that we've got a problem which far reaches beyond the repo market itself, and it has much longer term consequences. But when this starts to let go here, you're going to have other problems in the system as well.
I have a question from one of our viewers, Brock. He'd like to know if we're going to have a bigger repo problem due to low European bank confidence. Could the weakness in Europe play into this at all?
Is he talking about the euro dollar market feeding into this?
I think it's just European banks.
Yeah.
That the narrative was, David, we had cleaned up our act in 2008, but Europe never did. So could anything systemic happening in European banks also magnify this?
Potentially. I mean, the repo, there could be knock on into the financial markets here, but I mean, the repo market is, is a U.S. Market handling U.S. assets typically. But certainly, I mean, it's a question, I think, really of kind of domino intruding from another market reach into this market. But my argument is that, you're looking at the equity market here, but we could look at the Fed balance sheet to say that it already has reached into this market, and not from Europe itself, but ultimately, from domestic sources, from the Fed itself.
Okay.
So in summary, I think that the dollar shortage is possibly is likely much greater than what I think Zoltan Pozsar sees, looking strictly at the plumbing of the New York repo market itself. Now, I want to just touch on one thing, and that's the high yield market, the leveraged loan market. So leveraged loan market is lending to those who already have a lot of debt. So they're highly leveraged, and that whole market sector is called the leveraged loan market. And one of those markets is the U.S. shale industry. And what this shows here is from 2012 to currently, that U.S. shale production went from, in round numbers, about $1 trillion up to $6.5 trillion. So used to using trillions, from 6 million barrels a day, roughly up to 6.5 million barrels a day. So there, the U.S. went from a net oil importer of size to a net oil exporter, and much of that was a consequence of this cheap credit. Now, this curve here, this curve is the MZM, so that's the money zero maturity, and this money stock, its total money outstanding. The red line here is the money zero maturity.
Okay.
And the blue line here is the West Texas Intermediate oil prices. But you can see here the ramp in the money stock. Now this overcounts some elements, the MZM, but the Fed doesn't print the TMS measure, which is an Austrian measure, I believe, because it gives away exactly what their playbook is. But this MZM, although it's a little bit overstated here, you can see this ramp, and that through 2008 and on, we had the ZIRP policy in effect. But this availability of cheap money, you can see here with this, the crude oil prices collapsing, and that from this ramp up, here that we experienced between 2012 and currently in terms of the shale oil production, it brought on to the market a lot of unproductive, expensive oil because there was free money in the system. And by roughly 2015, the West Texas intermediate price collapsed as this supply of crude oil into the market collapsed the price down. I'm arguing that using just classic economics analysis, that when you double the money stock over time, so let's say you have $1 trillion in total money, if you double that total money to 2 trillion over time, the prices of all goods and services will double as well, everything else being equal. And so what we see here is that this tracked fairly decently, that the increase in the red line, which is the money stock, that the West Texas Intermediate price did track it for a period of time, but then collapsed as this supply of shale oil hit the market and drove oil prices down. But I'm arguing that the cheap money is now going away, and we're seeing that in the repo market, and that at some point the production at the margins from these unproductive shale producers is going to go away as well, and that we're going to see much higher oil prices. And quickly, just at the end here, Chesapeake, this is their credit default swaps, and they're 500,000 barrels a day. They're 500,000 barrel a day producer, the largest in the shale patch, and they're now into trouble again. And they
their stock's under $1 now.
It is. It's in the neighborhood of 60 cents.
Yeah.
And
the penny stock, unbelievable.
Yeah, so they're in trouble now. But ultimately, it all goes back, Dale, to the blowing of the credit bubble. And then just like in 1928, 29, the Fed ran rates all through the 20s there, and the mid-20s, at below the rate of the Bank of England. And in the UK, they were in severe trouble after World War I. The US economy was strong, and there was quite flush. They ran loose money throughout the 1920s, and then in 28, 29, they suddenly constricted the money supply, and the consequences of that were impacted the economy at that point. And
David, when I was trading back then, and I still have it, I have the ticker tape under glass.
Yes.
That's really what a tape reader was. I'm just kidding. I just have one more question before I say goodbye to you, and what a great presentation. I mean, you open my eyes to so many things every time you're here. Dominic Rudger would like to know, how do you think they can try to stretch a rubber band further into Q1, Q2 next year, assuming correction should happen before that? What are the ways to delay it? The reality of what you're showing us. Do they have any tools to stretch this out into maybe the election next year?
Well, I think you would have to look at the bank policy right now in terms of the reserves that they have to hold. And Zoltan, in that Bloomberg interview, and I really think people should go back and take a look at that, but it's from about 4 or 5 days ago. Okay. But he said that they could lower the reserve requirements. There's statutory requirements right now that are in place that are forcing the banks to hold more reserves. And so he's saying that you could release it in round numbers $1 trillion into the system very quickly if they remove those regulatory requirements. But he also points out that the Fed is unlikely to do that because of the criticism it would get. But it's that kind of thing that you can unleash $1 trillion into the system in a very short order, and also that would help Trump's reelection requirement. So I don't think the Fed is an apolitical institution. I'm a little bit skeptical.
Do you think they'll do that?
Do I think they'll loosen the regulatory requirements? No.
Okay.
They'll say that this was due to deregulation, and in essence, all of our problems come from the regulators themselves.
I see. A friend of mine pointing their finger at everyone else.
Well, a friend of mine, Larry Parks, always points out that they blame animal spirits, in the markets. But what happens when the regulators get animal spirits? Nobody asks that question. And so you've got these central planners here who are doing things that are not in everybody's best interests. And ultimately, our problem arises from central planning. It arises from the regulators, the control of the money supply, and what I would really say is really malpractice that they're undertaking when they whip around the money supply in the really inadvisable way that we see that they have historically.
What a great presentation, and I'm not the only one that thinks so. Everyone's saying it in here, David. So really appreciate you bringing your work to the table for us here in F.A.C.E a couple times. And again, David, appreciate it. I learn from you every time you're here. The best way for people to follow you, is it on Twitter at Real David Jensen?
Yep, that's my
That's the
handle.
best way.
Yep,
So,
Real
all
David
right.
Jensen. They can plug in there to the materials there. You can see it's down here in the lower right hand corner.
Okay,
Yep.
there you are. So don't go to the fake David Jensen. Go to the
No,
real one.
absolutely.
There was a fake Dale Pinkert on Twitter this week.
Was there?
Yeah, they do it. They do
Must
that.
must have been Heckle and Jekyll.
Yeah. Anyway, you've made it when people are using your handle. All right, it's a sign of success. Anyway, David, thank you so much. Appreciate the presentation, learning about things that I think are so damn important with what's going on here over the next couple years.
My pleasure.
Yeah, keep up the good work. You know what you are? You're a watchman for people that are getting carried away with the hopium.
It's
And
easy to get lost in the details, and the Fed relies on that. It's the
yeah,
big picture stuff that tells you what they're doing.
well, I'll tell you what, after listening to you, every time I listen to you, I look at a shovel outside and go, I better start digging that bunker.
Yeah,
All right?
gold's looking pretty good.
It is.
Okay.
All right, David. Everyone, thank David for being with us. That's a wrap for us. We'll see everyone tomorrow. And remember, no matter what's going on with money supply, don't just count your cash, count your blessings. And we'll see everyone tomorrow. Thank you, David Jensen,
Thank you.
the real one. Adios, everyone. You're welcome, Scott, John, Monica. See everyone tomorrow.